Hi, Warriors. Let's have a great week. Declare it. Text it. Hear yourself say it. We're going to have a great week. So good morning, Nikita, Sinatra, Mary, Mike, AJ thinks it's Friday. So, okay. Let's go to work. Now, before we get to the markets, guys, I didn't link it together at first, but I have to now. Can you guys see my screen?
Yes, we can see it.
Yes, sir.
All right,
Yes, Dale, we can see it. Yes, coach.
Yes, okay. Anyway, I don't know if you guys thought about it, but you know how I feel about, the number 3, on 3 drives and 3 strikes you're out, and we're the third planet from the sun, and the third time's a charm. But the number 3 showed up in the NFL last week. And the response, the way it manifested, was with love and brotherhood. So there's that number 3. Everyone's wearing that number in the country right now. All right, now let's get to what doesn't make sense. Friday's action in the currencies was wild. So I want to start with Cayman. And yeah, so the number was neutral and positive, spun that way. I have no idea what to do with the dollar right now. I have a hard time getting short. It looks terrible, but I just can't do it in the hole. And I don't see any reason to. I don't see any reason to buy it yet either. What's your take on euro here?
To me, I mean, euro dollar is one thing. I think, and I've also said on the flow show, looking at euro crosses, they are still finding demand on dip. So I think euro dollar may be a bit influenced by that as well. ECB playing catch up and stuff. Yeah, for the rest, I still think we're in one big yo-yo until we hear. Well, we should be hearing from Powell and friends tomorrow at an event at the Riksbank, but then on Thursday we're expecting the CPI. A lot may be decided there. Bigger players may come back in the market. What we see on these moves, which are very rapid, volatile,
really,
in my opinion, the real big players may not be full steam in the market yet, or they are just waiting for setbacks. And I trust that they are selling dollars on rallies. As we've seen, but the moves have been violent for the first week. I'm having a little bit of a trouble to really find the more medium-term trade right now. So I'd rather play those
swings,
those rapid moves, and then see what happens.
What do you tighten up your time frame to technically, Cayman, when you move towards forget the intermediate term? I just have to be opportunistic. When I have shorter term trades available.
Yeah, I mean, my time frame, I usually don't go as low as 15 or 30 minutes. I'm only watching them to see high lows and speed of things, but I usually don't go to anything below 1 hour.
1 hour.
4 hours, and still I think there are jobbing opportunities to be seen because we are in a volatile scenario. So we do see those levels. For instance, if you look at you're on the euro dollar right now. If you look at the middle of your picture, you see this box, which is this 106.40, 105.90 box, and every time you get out of it, you get a bit of an acceleration, and then you come back in it. You just wait and see what the next move is going to be, right? So for me, I only have some more medium-term stuff running in silver. Well, that's longer term, but silver and then euro sterling more medium long. medium-term long, but the dollar, I'm trying to be opportunistic, and whenever the volatility is there, ride it and then see what happens next.
Okay, now the yen chart looks more constructive than the
131 and a half, 134 and a half, give and take algo pips and a few stops here and there, and that's your box right now.
I mean, the dollar's on the verge of making new lows while the yen is still, I don't know, 250 pips off the low. So maybe we're putting in a right shoulder here. That's just a little bit of a potential thing I'm thinking about here. You know, that move in yields was dramatic as well, and it's still possible that we could hold, if we hold 340. I don't think you could completely write off the fact that, you know, we could still make another run.
We could.
Under 340, yeah, I think you're talking 268, 270. But if we're holding this and this is just a pullback and we get something like this or a fib extension of this, the markets would be offside on everything.
Yeah, we've basically undone the move that we did for the year end. From, if you go back to the like December the 14, 12, 15, somewhere like there, we started like a big move higher on the yields. The bond players needed to get out of stuff, and then we basically undone that move, and now I think CPI is probably going to tell us where we are going to. ISM wasn't great on Friday. ISM was like, I didn't really like it. So
that's when the acceleration really took hold.
Yeah,
after the ISM,
exactly.
right?
Exactly. You've got a bit slower wages, and then the acceleration on the ISM, and then the little line in the BLS report saying that they will do the revisions to the payrolls in next month. So the market may have gotten a little careful and cautious there, and sold dollars on the back of it.
Okay. Regarding silver, I took a shot last night. Last night I already covered it, but you know, I can't ignore this. It's a breakout of the gold silver ratio, and to me that spells an underperformance, not for all metals but silver to gold. So you know, I think that there's a chance we could correct this trade up towards 83, 85, and you could see it. Let me ask you this: when's the last time you saw silver, I don't know, what is it now, about 60 cents under the high, with gold making consecutive higher highs?
Yeah, there was an article out in over the weekend, I think, that over the past 2 months, China and Russia have been buying a lot of gold, and
the central banks
market wants to ride that train, and rather buys gold than the less shiny stuff.
Well, I think that's going to peak for a pullback as well. I'm not showing it here, but Blake, do you know how you get this RSI to stop cutting off when it gets over this level? Anyway,
you might just have to move the pain.
What a pain, no?
It is a pain, isn't it?
Yeah. Anyway, gold isn't confirming like it did here. Huh?
Try clicking on auto on the right bottom side. If you click on auto.
Oh gosh.
No.
Yeah, it worked.
Did it?
Oh no, it didn't work.
It didn't work on the RSI.
Okay. Anyway, so this looks like, you know, it could be drive to, but you can't argue with gold. It's acting great, but you have to ask yourself if gold, which is strong, begins to correct. I still think that Stelios is 22.20 or $22 is going to happen in the silver.
Let's see.
So that hasn't changed my mind. And then, okay, let's cover risk, because, you know, it came out of the hole. These aren't one of my favorite bottoming formations. And, you know, 39.50 is about halfway back for 4,061.8 back. I still think that before we take out this high, we'll take out this low and clean out. I'm sure there's a lot of people got long recently with all the bearishness and record put call ratio. And I think there's at least one sell stop under 37.60.
Whoa. You think we're gonna break down from here?
Yeah, that
I'm sorry.
doesn't mean it takes out the
I gotta
October
step in and ask why.
because I still think that the market's offsides on yields. And you know, we might get a great report on the CPI. To me, technically, this just isn't this was a rally to sell based upon what happened here. If you covered it up and you didn't have a bias and you didn't know what it was, and you saw this break and then a rally back towards here, you would view it as a correction. And a correction means that there's another break to the downside.
All right.
That's it.
Fair,
Just
fair
technical.
enough.
Yeah, you know, could be
Fair.
wrong. I'm wrong all the time.
So well, let me ask you guys this. I mean, that was a pretty weak ISM number. I heard K-Man saying, you know, hey,
Yeah.
I didn't really like that number. That number was horrible. If I'm not mistaken, I was traveling, by the way. That number came in the like mid 40s, didn't it?
Yeah, it's
It's not only that, every component was bad.
Yeah,
That's the thing.
so you know that and I know it's like it's weird that stocks move higher on that, but they are because it's expectations that the Fed may not even raise rates another quarter, which I think is
Oh, really? They were pricing in no interest, no hike?
No, I think that's where the market's going to start going, is that
Oh, okay.
direction. And especially if
I
the
know they're
CPI
talking
number
a
comes
quarter.
in weak this week. And we
Yeah,
got Powell tomorrow too, on top of that. So, I mean, if Powell, you know, is a little bit more dovish and we get, I mean, you guys have been watching all the inflation data, whether you're talking CPI here in the US for the last couple of months, but in Europe, all across Europe, energy costs are dropping. I mean, it seems likely that inflation data globally will continue to come in below expectations. Is that an unrealistic expectation? Stelios, K-Man, you guys think?
You know, my opinion, I think it's gonna, I've said it for a few months now, I think it's gonna be dropping quite quickly, and we're seeing 1% drops from the previous print in US in the Eurozone. We're expecting a drop from 6% to, actually no, hold on, from 7.1 to 6.5 in a year-on-year CPI. I think the risk is for this to be to come in below. But
yeah, I mean, imagine if we come in around 6.3. I mean, the stocks are going to be, you know, S&P is going to be trading well above 4K.
The risk we have is that the market's really moving against the Fed now, right? It's continuing to just taunt the Fed and say, no, we don't believe you, but you're going to stay on hold for the whole of this year after you're done. And by the way, you say you're going to be hiking a little bit more than we expect. The market just doesn't believe the Fed. And the risk, I think, with Powell tomorrow and with markets having gone the way they have, so yields have been dropping, the dollar's been dropping, risk has been rallying. I think the risk is now for a more violent move if we get a positive surprise.
Powell.
Yeah, a hawkish.
Yeah.
Exactly. Powell.
Oh,
and
that's
also the same.
that would definitely produce the bigger move at this point.
And the same for
100%
CPI on Thursday. CPI on Thursday, I think it's going to underperform, coming lower, but of course nobody knows, right? So I think the reaction is going to be a lot more savage if we come in line or better than the expectation, rather than the other way.
Did you say savage?
Savage, yeah.
You said
remember
savage?
Randy Savage, the macho man. Remember him?
Go tell the Bed Bath and Beyond shareholders that inflation's coming down, and they'll say, so what?
Yeah.
So now the narrative could shift from risk coming in because of economic weakness, if you want to go to that side of the field. And what the numbers are already saying that, right? So, you know, maybe, you know, low rates don't help the market as much as a lot of people think it would.
Well, well,
something to think about.
Yeah, I mean, first of all, Dale, I wanted to show you why I question your what you're talking about with the S&P.
Question, Dale? Seriously?
Oh my
goodness. No, this is just the chart setup that we had. We had this nice tight triangle formation. We broke higher. That should take us right to here. I mean, it should theoretically
4,
take us right to about shy of 4,000. Now the question is, are we going to be able to get? What's that?
That's what I said.
Yeah. Well, the question is, can we get above that? Like, can we get above these levels? I mean, I sit here and go, you know, and I kind of ask the question, do you think that the Fed really wants the stock market to go too high?
No.
I mean, because that's the one thing that's you want to talk about something that's going to really inflate the market. If the S&P really like gets above the 200-day moving average and we start trading, and I'm just going to, you know, say theoretically we get up towards like 4,400, that's going to produce a lot of like, you know, you're going to get that, you're going to get a lot, the knock-on effect is going to be inflationary, and you're going to get, you know, sentiment improving, people starting to spend, you know, people start spending their 401ks at the, you know, at the rest, at the, you know,
Mall.
Strip
at
club.
the mall or wherever else,
Mall
you
that's
know,
closing.
Restoration Hardware and all those high-end places. I mean, it is going to be inflationary if you start to see stocks move higher. So I don't know if the Fed really wants to see it move up here. I think that's still the risk, though, before we roll over, as we start moving up towards those areas. But anyway, do you guys have any views on that?
Well, wouldn't it be the case that the Fed actually, I wouldn't say likes it, but rather have it go higher, meaning that the market believes in a soft landing when your asset markets go higher, than if the S&P would be collapsing, because they are taking the rates too far. I think they don't really mind being around here or even above 4K in the S&P. I don't think the Fed, they could actually claim it as a bit of a victory, you know, saying that, you see, we have orchestrated a soft landing. Asset markets are still at high valuations.
I agree with Cayman.
And-
I actually, sorry, carry on. I didn't mean to interrupt.
Yeah, and just one little add-on is saying that let's not forget we are entering earnings season as well this week. I think later this week, they might have an impact. That might have an impact on stock markets. Please proceed.
Just one thing I wanted to say was the Fed really cared about where the stock market was when they were doing 75s, because really they couldn't afford to crash the markets, right? They were really looking, I'm guessing, they were really looking at stock indices quite carefully. Now that they're almost done, I don't think it's a priority for them anymore. In fact, probably because just like Cayman said, you know, it's going to signal a soft landing. Look, you know, inflation's come down or is coming down. Stocks have not collapsed. Yes, victory. Thank you. You know, we'll take all the credit.
Yeah.
So yeah.
Interesting. I do believe that stocks could go higher. I mean, definitely the Fed's they're gonna prefer stocks going higher than moving lower, and not capitulating lower. But I do think it's going to be against their mandate if we do have the stock market that starts holding higher while inflation is still up at 6% year over year. You know, if the inflation rate is, you know, 3%, like where it may be, let's say at the end of 2023, and we're back at 3%, I don't think they'd mind if stocks were rallying at that point. But it's where inflation's at year over year right now is more problematic. But anyway, I find it fascinating, and I think that stocks have a lot of upside here. And I think the market is trying to price in a Fed that's really close to terminal rate. And I think that the market could continue to price that in a little bit. You know, one of the things about the euro, you know, I just picked up some euro about 12 pips ago. If you're in the ForexAnalytix community, here's the chat room. You can see I just picked up the euro dollar at 106.86. And I bought some because I think the risk is that the euro still completes this flag pattern and has even further to go. Because if you look at this technical flag pattern from this move, from the triangle, that actually takes us all the way to 110. And I think that's a risk. You know, the euro could retrace 50% of this entire move lower. I mean, are you guys prepared for a higher euro there, Stelios? And Steve, if
yeah, I want to come to the US. I would love that.
Yeah, I know. Poor Steve. He came to the United States at the euro's low.
Yeah.
I know. Steve, are you all right? He's
No,
not here.
see, he's
Okay,
not.
I was wondering if he was checked in here.
I'm
But,
here and fine, mate.
Oh, you are. All right. So, Steve, you marked the absolute low in the euro by coming here to the United States. Funny thing is, I did that opposite in 2003 going to Europe. So,
I know what I'm doing.
you're really good. You're really good. Anyway, so Steve, you have any views today? You've been relatively quiet. You have any thoughts here?
Listen, I have to say that I'm rather surprised. I was expecting the exact opposite type of reaction from the data we got on Friday, the employment data. The only piece of data that wasn't, let's say, according to the usual perception of market participants as dollar positive and as risk positive was the wage growth, which was a little bit slower than expected, 0.3 if I remember versus 0.4. Everything else was theoretically what risk bulls didn't want to say. Now, I don't want to be fighting the tape. This is a mistake that amateur traders are frequently doing.
Amateur traders, you could group the 20-year veterans in there too.
Yeah. So I don't want to be fighting the tape, as a tactic. On the other hand, I can say that I would definitely give it a little bit more time to see today and tomorrow if perhaps the market changes its mind, or perhaps if it was some kind of an overreaction, because we said multiple times that liquidity wasn't at all fully back last week, right? So I want to give it another couple of days to see if this is a real move for one reason or the other. The market really wants to believe that that's how it should interpret the data. And if that's the case, technically speaking as well, I'm looking at several FX pairs and equities. Then I'm going to be, more than happy to be short the dollar. It's going to take a lot more convincing, though, to get me long equities, I have to tell you. In general, I was looking for a dollar rebound higher to extend further so I can be short the dollar. So in general, I want to be short the dollar. I'm just not convinced that this is the place we should be. I still believe that there is a decent chance that we're going to see a higher dollar first before we see the dollar depreciating further. But as I said, this is going to be an important week to determine that.
Yeah, right. This week is going to be really important.
Yes.
Well, right now, we have the euro breaking what, we're getting close to 107, and actually we're above 107. I take that back. And we start breaching some of this resistance up here. You're going to get people that are A, getting squeezed out, B, are going to start chasing it higher. Upside might be fairly limited because we might this is like unfinished business that just has not been taken care of yet. So, maybe we only reach for 107.70 ahead of Jay Powell tomorrow. Remember, we do have Powell's speech. I think K-Man talked about it a little bit earlier. That's going to be, obviously the next hurdle.
And most importantly, this is the week we get CPI data, right? Which is going to be...
Yeah. So people are going to be a little bit more hesitant, like Steve, to chase the market higher or dollars lower at this point. I want to ask Dale, I know you talked a little bit about it as well. What are you going to do with precious metals here? Because look, silver was rolling over coming out of this wedge. We actually, ironically, we're knocking our head up against the underside of that trend line of the broken ascending wedge. We didn't make it down to 22 and some change. We bounced back up, and gold is, not giving us that throw over there. It's continuing higher. What do you do with precious metals here? I was traveling on Friday, so I didn't see it as it was happening, other than the ISM. Once that came out, I saw that secondary move. I shorted dollar Canadian in front of the group, actually, when I was there on Friday,
Nice.
for the secondary move lower. But I didn't didn't, you know, I wasn't there for the initial move lower. So I'm sitting here looking at gold and wondering, you know, hey, how high can we go? What do you guys think?
Well, look at your RSI that you just showed.
Well, it's divergent, but how about if the RSI breaks out? I mean, you know, this is a divergent relative strength, but just because it's divergent,
I think it was
doesn't
a
mean
chart
it can't
before.
like do that.
Yeah, I'm
So-
looking for a top between here and 1900, and I sold silver last night, took 20 cents out of it, and gold silver ratio tells me your preferred short is silver and your preferred long is gold, and I think it's going to be that way for a
Yeah,
while.
that makes sense. I think gold, how about if we do break above you know, 1900, because this is the 618 retracement. We start breaking above that, and you know, next thing you know, we're trading, you know, closer to 2000.
Everything can happen.
Yeah, I mean, that's it looks really bullish. And by the way, the euro is just
I would
plowing
short
higher.
the silver instead. So
What's that?
I'll just pose this question to you. When's the last time you saw gold making 2 or 3 successive new highs with silver 70 cents under its prior high?
Yeah, I don't
And
know. I don't follow it close enough to
that's pretty indicative of relative weakness.
Got it.
compared.
Well, you know, I'm sorry, guys. I'm just thinking about what I should be doing here. K-Man, do you have any last minute thoughts before we wrap up today?
No, not really. I think market is happy to sell dollars, returning around 360 in the 10s. So that's something that we perhaps should be keeping an eye on. 355, 356 as well. No, the market is just a continuation of what was going on Friday, really. So yeah, the market is still feeling very comfortable selling dollar rallies. Yeah.
Yeah, I mean, yields do look weak. God, look at the dollars just getting pummeled here. I thinking about just taking what I have off and then reestablishing it after the North America opens. But you know, half of me wants to do that, but the other half of me thinks, oh, let's let the dollar break down, because I want to point this out because I discussed this on the week ahead video extensively. This is the COVID breakout point. So this was the post-COVID lockdown highs. Remember when we had the lockdown, right? Then we rallied past that and it was breakout city for the dollar. We break back below this breakout point and the dollar could really get pummeled. And that's why, you know, when I look at the euro and I'm like, okay, well, you know, we are at 107. I mean, could we reach for 110? My opinion is we could, especially, you know, you get longer term dollar longs getting, you know, really stopped out across the board and people reversing positions. You know, the euro could extend to 110 before it's all said and done. So I mean, the dollar is at really, really, really critical levels here, I think. So anyway, hey, Dale, I want to mention this before we wrap up. Do we have any news coming out, Stelios?
Not really, no.
Okay.
I think we have Mexican
right.
CPI or something like that.
Hey, if you guys have not seen this yet, we have actually lowered our prices for our New Year's special. It is 40% off the annual prices, and we have buy 1 month, get 1 month free. So all the pricing is in play that I talked about yesterday. It went live this morning. So make sure you guys take advantage of that. Remember, once it's gone, and we only do it a couple of times a year. So just want to let everybody know that. Any last minute thoughts and ideas before we pass it back over to Dale?
I think, Blake, I'm going to reiterate what I said before. I think this is the first week of the year we should be paying more attention to. People are going to be coming back to their desks. Liquidity is going to be coming back. So we have CPI data also, which is a huge factor for Fed policy. So I think this is a big week and will determine how we move forward from here for at least several weeks.
All right, that's some good thoughts, and I agree with you today. This is going to be a really important week. Stelios, any last minute thoughts before we pass it over to Dale?
Not really, no. CPI Thursday, Bernanke tomorrow. If you don't know what to do, it doesn't
Did you
matter.
just-
It's okay. Not it doesn't matter. It's
Did
okay.
you
Again,
say
Bernanke.
Bernanke tomorrow?
Did I say Bernanke?
You did say
Jesus Christ.
Bernanke.
Yeah.
Jesus Christ.
Yeah.
Okay. Anyway, I was just
Stelios
gonna say,
remains in love.
Yeah, let's keep
I
our
was
eyes
just
out
gonna
for
say,
Xage coming up too.
if you're not sure of what you want to be doing, it's okay. Take a step back and think about it again. Bernanke,
right.
I love you, Ben.
Very
He knows
good.
it,
All
mate.
right.
He knows it.
Hey,
You guys.
just remember we're gonna be on the morning edge here in about 45 minutes for the ForexAnalytix subscribers. But if you guys aren't listening to the European show with K-Man, Ryan, and Stelios, Ryan was out doing some
Sweeping.
yeah, sweeping or something, whoops, something like that. Anyway, make sure you log in here to the Flow show every morning. It's free for you guys, so you get up to speed with us. If I wasn't sleeping, I'd be there every day for sure. So great show. Make sure you guys are logged in, and Dale, we're gonna pass it over to you, bud.
All right. Thank you, team.
All right.
Let's have a great week. Steve Miller, Happy New Year, buddy, and welcome back to F.A.C.E.
Hey, Dale.
Hey, really looking forward to talking to you today, Steve, because
Wow, I was looking forward to being here.
all right, cool, because I have a decent memory when it comes to what other people say, not what I say. That's I could just be a revisionist, but I do recall on our last conversation, you said the market would bottom in October and that we'd have a rally, but that's not going to be the low in the market, and you thought it might happen this coming spring. And I've noticed that really has become, back then it wasn't, but it's really become a consensus opinion. Are your cycles still saying the same thing? And
Absolutely.
was I correct?
Now, are you cheating and watching my more recent shows?
I
That's
have
what
a
I want.
webcam. I have a webcam in your office, Steve.
Yeah.
So, anyway, the NSA provided it to me, and I'm
Yeah.
just about intelligence stealing from
Yeah,
everybody.
that's my analysis has not changed. Actually, it was at the end of 21, beginning of 22,
Yeah.
that I did the year-end show, and I talked about the markets coming down almost exactly to the levels they did at this timing. So,
Okay, you want to share your screen, buddy?
it was a really good year for the analysis. Sure, I'll share the screen and I will show
Okay.
that.
Okay.
So let's see. You should now be seeing the screen that has the S&P 500 weekly on there.
Okay.
Is that, you see that?
Got it.
Okay, good. So what you're looking at here, and there's going to be a lot of people that say this is a bunch of spaghetti because they're not familiar with this style of analysis, but we look at the energetic movements in the market. Those are repeating cyclical patterns. And once your eye gets trained to do this, it's very obvious. And we have 4 analysts that do this kind of work at Slim. What we were looking at here, right in this area, right over here at the end of 21, beginning of 22, was the likelihood of a peaking market based on some of our longer term work that was right in this area. And once this cycle, now I want you to note the cycles that are we're looking at the bottom right in here, and there's a more dominant one, the dotted line there. So this cycle resolved itself like this: bullish, as it makes a higher high and higher low, bullish. Then it made this negative cycle right there that warned us that there was a top forming. And that's actually how Head and Shoulders form, by the cyclical action. You could see the left shoulder and the head and the right shoulder. Once, I'll take a little closer look right in here. Once that right shoulder formed, and then this important low broke, that confirmed that the cyclical pattern was declining. The minor cycle makes a low here and the minor and dominant low over here. Now it can be plus or minus a few weeks, so that's not that significant. We were looking for a temporary low right over here coming towards the end of the year. We thought it would come either late December, early January, and then a rally back up into these resistance areas. So we were calling for a January rally in the stock market, which took a little
We're getting.
while to get traction in there, but now we're looking like we're getting that into these resistance zones. Now, these yellow ovals that you see are areas where the dominant forces are pushing to the downside. They're the most likely areas to get decline as money flows move back to the downside. You see the failure in resistances here as it brought it back down, and the minor
wasn't in the
resistances
yellow.
here.
Yeah,
The
so
yellow,
it was. Yeah.
the yellow area really is coming up over here after this rally is over with.
Once
the
it
period,
starts, the end of the month, Steve?
well,
we'll
you
be
really have
back
to
in
go to
yellow?
a daily chart to really see that, to get some idea of that. And I'll show you that right over here. Here's the cyclical patterns on the daily charts. And you can
Okay.
see the phenomenal cyclical movement that's in here. And we were projecting, and you could see the inverted head and shoulders right in here as that formed. And
Yeah.
that was that was formed by these cycles right in here. And now we have actually two projections in there. The highest probabilities it gets up into the sell zone right here. That's let's just call it 39.30 to about 39.75. That's the highest probability. The lowest probability, but still, I would say this is 70%, this is 30%, that it gets up close to 4,100 in an upside panic. But then you get into this area right over here. So our work on implied volatilities on the VIX suggests a late January peak of this rally. The reason for that is the VIX shows a late January low, both on intermediate and short-term cyclical patterns. So we've been looking for a rally into late January, even though being negative, but just the way the patterns work out. So we would look for this rally to continue for probably at least another 2 weeks, maybe 3, before we get into the short-term period of downside risk and then this intermediate period of downside risk. And based on the highest probabilities, it would be a test of 3,500 on the downside, with the potential getting to as low on this fib projection as maybe 33.33. During that time frame. Now, were this to decline and not make a lower low, that would be a pretty good sign. That would just simply say that this next rising phase out over here has a very good chance of getting up into these higher resistances, maybe even 4,300. But we have called this year to be a positive year, even though not real positive. After the spring low, then probably the Dow making an all-time high because money is moving into those stocks because the
quality.
The growth stocks are done, and people that are bullish on the growth stocks, the FANG plus stocks, are going to be pretty disappointed by how quickly the rallies fail in there. And then I think you're going to see the S&P 500 fall pretty short of the all-time highs this year, even though you're probably going to have a good rally from sometime in the summer into the fall. With they call them the moat stocks, the ones that are the top leaders in the individual groups. Those are probably the ones that are going to be the movement into safety. And that's why I think the Dow could actually make a new all-time high this year, with the broad market falling way short.
Okay, I do remember you being sanguine about gold, and you said it was going to move lower, but you weren't worried about it because it sounded like you had a lot of conviction there was going to be an important buy there.
Gold
and that manifested.
Gold is really interesting in that you can see our big cyclical patterns right in here, and we were looking for a low to come in gold out over in this area. It could have bottomed actually over here in that 1677, but it's not the worst thing that it bottomed where it did here. And you could see we actually had a potential low in that area, but it likely shifted out a little further, and that was okay with us. Then we were projecting that this major dominant cycle here would bring it to all-time highs sometime in coming years. And our monthly work shows that also. What's really, I think, interesting right now is that with what we see in the amount of gold being bought by Russia and China, and actually silver is being bought by India, not as much gold, I think there's a major move by the BRIC countries to overthrow the US dollar. I mean, they really want to do that. Now,
Yes,
I'm
they
not
do.
really bearish on the dollar right now, but I think that they want their currencies to be the sound currencies in the world. And that, I think, is going to push gold surprisingly higher during this period. Now, you see, we only have it projected modestly up to this resistance level right now, which is around 1900. But the truth is that this really needs to be upgraded, because the probabilities of getting over 2100 in the next 1 to 2 years are very high. And maybe it's 2500. I mean, I really haven't projected that. Now, I'm not as bullish.
It looks like shorter term, you think it might be vulnerable to a pullback. Am I reading
Well,
it correctly?
I'm listening to what some of your people were talking about who are bearish on the dollar. I'm bullish on the dollar right now. I mean, I think the dollar has a period coming up. I'm going to go to short-term gold in here. And you can see we're kind of looking for gold to come down into here on the short term and then, really get an opportunity to buy it again. I think it's a buy between 18 and a quarter and 1790, right in there. To go up again. That's where the supports are. Supports are actually rising in here, so they may be a little bit higher. But we have a major bottom or intermediate bottom being in the process of being formed in the dollar.
Well, that's interesting. That's very contrarian right now.
It is actually. And I'm just going to go to the weekly dollar right over here and show you the bigger patterns right in here. And we were bullish in the dollar and then bearish in the dollar. And you can see that the patterns right in here were these this minor cycle and dominant cycle coming down right in here are where this should be coming down to. Now, this is you can see in here, I haven't been illustrating this, but this is our proprietary indicator, the SLIM Reversal Scout. And you can see where it turned negative right there. Where it turned positive right over here. It's still negative right over here. And all of the momentum indicators are still negative on the dollar. However, we're getting into this bottoming area right over here. And I think that the relationship between the interest rates in the U.S. And the situation in the U.S. And the interest rates in Europe and the situation in Europe are going to bring a dollar rally also, despite the fact that the cyclical patterns suggest that. And that might be, we're not projecting it to get back up to the panic levels up here around 115, but it's very reasonable in these next 3 months to test 108.
Okay.
So, and
50%
that would be
or so.
Yeah, it's actually 32%, 38.
Well, that's weak. Yeah, it's weak.
Yeah.
That's a weak rally, but it
Right, but
would shake people up.
It's still a rally. It would get the metals pulling back down. It would be, we're super bullish in copper, but that might slow that down right now.
We're right at major resistance in copper, right at the breakdown today.
Yeah, I'll look at that for you in a second. But you could see in here these dollar cyclical patterns. They're just gorgeous. And the short-term pattern is due to bottom right now also. I think it's a little capitulation going on.
Okay.
And I think the dollar is going to be going up. And I just think that Europe's situation is really bad. And I think that the euro currency, I'm just going to go to the
back to par.
I think the euro currency is just getting ready to roll over. That's your daily right there. So it's just, coming up and testing those highs. And here's your weekly, and you can see that gorgeous head and shoulders that made that top. And this is actually a very bullish pattern here for the intermediate and longer term in the euro. Now, I'm looking for this pullback over here into late February, early March. That will give that dollar lift that we're talking about, because you could see this cycle coming right in here for that bottom. So you get a dollar lift right in here, but then the dollar doesn't go a lot further than just these next, 3 months basically. And then euro gets stronger again right over there. So the dollar doesn't have a lot of time, but that would be probably giving a good buying opportunity for the metals in there. Copper market that we just talked about is just a spectacular pattern. And I'm listening to your guys talking about Powell and being bullish on the markets because the Fed is almost done. I really strongly disagree with that. And that might
You like copper because of what's happening in China, Steve.
I kind of think that it's the China getting past the COVID lockdowns and all that. Look at this magnificent pattern. I mean, it's just one of the strongest patterns you will ever see. And the copper market looks great.
Yeah.
My minimum upside projection is about 435 in there, but I think that's really going to go much higher, but it might just rest out in here on this first minor cycle before it does get to take off in there.
Could we wrap it with yields?
Yields,
yeah,
you can. The yield market in here, and I'm just going to go to TNX, which are the 10-year yields, and that is the yield market essentially made a low. And now the question is it testing that low or not? You can see that right now that low was early right over there based on what our projections were. It wouldn't be ridiculous for it to come down and test the 344 area. But what is very clear to me, and if people are thinking that, the stock market's going to explode to the upside and run away, and we're going to continue with the bull market, they're living in an old paradigm. And that the Fed is done with that. Fed is completely done with that. They know they have made massive mistakes, and between government insane money being printed and the zero interest rate policy for so long, we have a lot of problems right now. And that the reset that has to go on is going to take years and years. Not people looking for the Fed to come down and to pivot in this year. I think it's insane, to tell you the truth. They really have to be very, very tight for a long period of time. And they were very clear. We do not want the financial markets to counteract the work that we're doing. They're not going to let yields in these futures markets go down anymore. They're going to get in the way.
The market is fighting the Fed. So tomorrow's going to be a pretty good example of the Fed fighting back, isn't it?
Yeah, they are. And you're not going to get Powell to say anything that says, that is bullish or interest rates are going down. Some of these, if you listen to Fed George, the likelihood of interest rates reaching a level, which is probably 5.25, and the Fed staying there until 24 is very high. And she has no reason to lie. She's leaving. So the interest rates are going to stay very high. And I think that the hope for interest rates, pausing is the best hope you have, and that's going to be over 5%. Interest rates could get back up to this over 4%. That's what we're projecting right over here later on this year. And if not, there's this doom loop going on in between commodities and interest rates, and that is that if interest rates fall, commodities are going to rally. They're going to take off like crazy. And that's going to bring inflation back. There's no way that you can get inflation to fall here very significantly. Best case may be, year over year, 4.5%. Best case, that is way higher than the Fed wants. And the Fed is going to stay very tough. We did our year-end show back last week, and you can go back and see that on YouTube. And I believe that we have through this decade of the reset going on with bull markets and bear markets, just like we had in the 70s, but a world in which there's going to be disillusioned stock market investors.
Yeah, and disillusioned employees at Bed Bath & Beyond. That rates won't matter.
That company.
Do you think we're about to enter a period, Steve, where we have some credit events that hurt the market, or possibly the bond market? We went through this phase, and now solvency and credit spreads never really blew out. Do you think that's still missing?
I actually think that if you go back and look at what 2000 looked like, coming off the .com or the great financial crisis, things are very different now. Now, you really have to give some credit to the Fed, to the government, and I absolutely despise them. So it's really hard for me to do that. And that is, they really made the banks solvent. So they got tons of money, and what they've done in things like the repo market and put in facilities in there that they could loan unlimited amounts of money, essentially. While that is super inflationary and is incredibly invasive in the markets, it still does create a cushion in there. So I don't really think you're going to get that type of deflationary issue going on. I think there's a lot more risk of inflation until the day comes when the built-in deflation takes over again. And that really is an unraveling of the energy markets in the world. When alternative energies really, when technology catches up to where alternative energies really take over, then the fossil fuel market is in trouble, and that's going to bring the next deflationary wave, and that could be some number of years away.
Okay,
so
interesting.
I see somebody asked there about recession on the chat there, and we're, I think you're already in a worldwide recession right now. I think the United States is probably going to be in the better shape of most of the other markets.
Could that better shape, Steve, be that the majority of Americans, although rates have gone up, locked in their mortgages under 3%, which gives them a cushion that other countries like Canada, where there's much more variable rate mortgages, can keep this consumer kicking longer because it's almost like $1,000 worth of income every month because they're locked in at 3%?
Well, I think that might be a smaller portion of the economy than you're suggesting. It is a benefit, of course, but I do think it's a smaller portion of the economy. It's probably offset by certain parts of the industry, like the refi aspect of the industry, which is crushed, but again, just like the great mortgage crisis, you don't have the mortgage issues now that you had back over then. So it's different. The crisis now is different, and I think that the biggest portion of that right now is that we were living in an unreal world, and that is. And you can look at cryptocurrencies or NFTs or SPACs or a crazy 200% stock market to GDP valuation to the craziness that was created by the government and the Fed over this last decade. And now we're in the reset phase of that. And people, I think, are going to be shocked by how long that takes.
So we're correcting all the malinvestment from free money.
Yeah, I mean, just go back and look at other corrective periods. You can look at, 1929 to 1942. That took 13 years. You can look at 1968 to 1982. That was about 14 years. I mean, those are, periods where it digested massive economic growth periods and Fed invasiveness, government invasiveness. And what happened was it took a long, long time to correct that.
Steve, outstanding presentation. I have one last question if you want to answer it. What's your best trade you're looking for? And I used to say all of them. I used to say all of them, right?
I look, we look at over 300 stocks in 24 different futures markets and indexes.
Yeah.
And so there's a lot in there. I mean, I just showed copper. We have been talking about copper as one of the best trades right now. And I think that looks really good, even though it might have some pullbacks in here. And then I think if the S&P 500 gets up close to 4,000, that short side trade is going to be one of the best trades.
You're brilliant because I agree with almost everything you say.
That makes you brilliant, doesn't it?
Steve, really, I'm rooting for you this year. Best way for people to find you and look into working with you.
Yeah, well, all you have to do here is go to AskSlim.com. As you can see, you can start out for $45 getting our 3-month level 1 membership, and they're going to get daily information from us, especially if they're short-term traders. They're going to love that. There is so much in here in our website. We have really 5 different membership levels that you can see right in here, all the way from free all the way up to $239 a month, depending on what they really want. So we have just a tremendous amount of information that we give. We don't give trades. We teach traders how to use our style of analysis, and then really get a good sense for who we are. If you go to the workshop tab right over here and you see cycle analysis workshop, there's a video in there, and our cycle analysis workshop took me 2 years to write and to develop, and there's a video right in here, and it's going to tell you all about it if you just watch that. So you'll learn so much about what we do just by going to our website. And if you have any questions, just write team@askslim.com, and our team will be able to answer anything for you.
Where do you trade from, Steve? Where are you?
I'm in Sarasota, Florida.
Okay. All right. Well, Steve Miller, you always present elite analysis. Appreciate your giving spirit to come in here and edify the F.A.C.E community, my trading warrior brother.
Well, glad to do it, and look forward to next time.
Yeah, I'm glad our paths cross on Twitter.
Yeah, for sure.
I really love your work, Steve.
Thanks,
you
Dale.
for sharing
Appreciate
it.
that. Yeah, glad to
All
be
right,
here.
so
Okay.
Steve Miller, follow him at Ask Slim and take it from there. People are saying thank you. They're Steve Miller Band. Yeah, they were pretty good traders too. And thanks once more, Steve. People enjoyed it.
Okay, thank you.
All right. You
Bye-bye.
could join the team in 20 minutes on the Morning Edge. I think Steve laid out some value added for everyone that heard him. I know he did for me. So adios, everyone. Don't just count your pips, count your blessings. And the power of number 3 showed up in the NFL. Result, love. Adios.